Good morning, everyone watching live on BAM YouTube. We are again in a new location. We're thankful to be at the Tomo headquarters. Thank you for letting us use your office. Let me know in the comments which market you are tuning in from. The hot sheet covers what you need to know about the real estate industry in a 24-hour time period. And on today's hot sheet, I will cover jobless claims, CEO confidence, CoreLogic's home price insights, and consumer perceptions on today's housing market. Today is Thursday, February the 9th, 2023, and the hot sheet starts now. Here we go, the hot sheet that is seemingly the traveling circus these days. The last 2 weeks, if you've been following along, we have just gone from location to location to location here in Stamford, Connecticut. Hit the thumbs up if you've been following along and enjoying all of these new sets. I kind of like this one. It feels a little CNBC-ish. We've got a lot today to cover. Let's jump right into it, starting with a jobless claims report that just came out today. We've been talking a lot about jobs on the hot sheet because we know the Fed wants their job to be easier, which means they would like to see this job market loosen up. We're at our all-time low for unemployment in the last 50 years. So what happened last week with jobless claims? That information is out today. U.S. jobless claims pick up for the first time in 6 weeks, pick up. And by picking up, they beat expectations. We were expected to have 190,000 jobless claims. We actually got 196,000. The 4-week average is about 190,000, which is the lowest since April. Applications for U.S. unemployment benefits rose for the first time in 6 weeks, but are still historically low. Okay, so they did rise 13,000 to that 196,000. This is according to Bloomberg and the Labor Department, and the estimates were 190,000. You can see here on the initial jobless claim chart that we are trending up, but still nowhere near where we were mid 2022, and certainly very low as you look at this historically. Continuing claims, which include people who have already received unemployment benefits for a week or more, increased to 1.69 million in the week ending in January 28th. Why is this important that we're actually seeing a little bit of a slight increase? Because Jerome Powell and the Fed want to see this job market loosening up. They want wage growth to slow down, which it has been slowing down despite the fact that we saw that really explosive job report in terms of new jobs last Friday, right? We saw 500,000 new jobs when we were expecting less than 200,000. That in turn got the 30-year fixed rate this last week to go back up to close to 6.5. Luckily today, and we're going to talk about this at the end of the hot sheet, the 10-year has reacted positively. Maybe we'll get a slight decrease in the 30-year later today. But the markets are looking at this strong job growth, and they're saying, okay, well, the Fed might react in March with a 50 basis point increase instead of just a expected 25. And that's why you've seen the markets go down this week. Today, they're trending in a more positive direction with this slight uptick in jobless claims. So we'll keep our eye on that. A little bit of momentum here in the right direction as it relates to bringing inflation down and what the Fed may do. Not overwhelming, not a huge gap by any means, but certainly interesting to take note of. Okay, let's see what CEOs, how they're feeling right now, because we've had kind of a up and down week, right? We had the FOMC meeting last week. Jerome Powell came out. He used the word disinflation multiple times. Markets reacted very positively. We saw a 10-year drop almost down to that 3.4 level that we're trying to target so we can get into the fives and stay there on the 30-year fix. And then on Friday, it went right back up with that jobs report. So what do CEOs right now think about this economy? Let's take a look. This just came out this morning, the Conference Board measure of CEO confidence. It's in collaboration with Business Council. Okay, so this is 142 CEOs, I believe. Yeah, 142 CEOs participated in the Q1 survey, which was just fielded the last couple of weeks, January 17th through January 30th. 93% of CEOs surveyed still report they are preparing for a U.S. recession over the next 12 to 18 months. That's compared to 98%. So 5% said, hey, I'm done preparing for a potential recession that we've been talking about seemingly forever. They also still expect that a recession will be brief and shallow. Okay. And this is what a lot of people are saying right now. This recession is going to be a shallow recession. They don't believe, it's going to be long-standing or deep, with limited global spillover. 86% believe that. However, the percentage who are preparing for a deep recession dropped from 13% in Q4 22 to 7% in Q1. So only 7% of 142 CEOs that were surveyed believe we're heading into a deep recession. The consensus out there is still that we will have a recession, albeit very shallow. Some CEOs are somewhat less pessimistic. Nonetheless, 55% of CEOs believe that a global recession is the greatest challenge for their companies. Okay, that makes sense for CEOs who are in the global markets and selling products all over the world. I've said many times, when we're looking at housing, when we're looking at our local communities, what's going to be the greatest challenge? It's going to be what we keep talking about. It's going to be jobs, right? We saw today, in fact, Disney, if you're local to Orlando, Disney's laying off 7,000 jobs. I don't know if those are all in Orlando, but that's a headline this morning. Disney's laying off 7,000 jobs. So what are the dynamics locally? How are jobs impacting our local market? I think that will have a more significant impact than a global recession. Now, obviously, a global recession can impact people's jobs in your local market. So they do kind of tie together at times, depending on which market you are in. It's why these are all good things to keep in mind. Of course, all of our sources and downloads are going to be down below. So if you want to dig into this a little bit deeper, you certainly can do that. Let's go and look at some of the conditions here from CEO current conditions. 16% of CEOs reported economic conditions were better to 6 months ago. Okay, so when the Fed really started jacking up rates, that was just in the middle of the year last year. So 16% feel better about the economy, up from 5% in Q4. 55% say conditions were worse, but that's down from 81%. CEOs were more optimistic about conditions in their own industries as well. CEOs' expectations about the short-term economic outlook improved to start Q1. And they also regarding short-term prospects in their own industries improve. So improve. They're all basically feeling a little bit better than they were in Q4. Just spoke to a CEO moments ago, the Tomo CEO. He's feeling the same way, right? He's feeling better about Q1 than he was in November and December. Employment, 37% of CEOs expect to expand their workforce over the next 12 months, down from 44%. Okay, so less CEOs are expecting to go out there and actually hire and expand workforce. Hiring qualified people, 57% of CEOs report some problems attracting qualified workers. Okay, that's been a huge issue throughout the last couple of years, right? Especially we're at an all-time low in unemployment. So going out there with people that are looking for jobs, really qualified people, there's a lot of CEOs reporting far and few in between. Wages, 81% of CEOs expect to increase wages by 3% or more. Hopefully Jerome Powell doesn't look at that. He does not want to see wages increase, right? Fed keeps talking about wanting to see wage growth slow down. Okay. Told you it was going to be action packed. We've got a report out from CoreLogic just this week for February 2023 and their outlook on home price insights. What does CoreLogic and all of their data have to say right now? Okay, so this report features an interactive view of our HPI, home price index product, with analysis through December 22 with forecasts through December 2023. So we're going to get some forecast models here from CoreLogic. We talked about it earlier in the hot sheet, right? Let me know in the comments if you remember all these people talking about 20-30% drops, and I keep stacking up evidence nationally to the contrary on these 20 to 30% home price drops. Well, let's see what CoreLogic says right now. And actually, I will go to the slides. These slides are going to be available for you in the daily download below. You get all access to all of our sources and slides in one place, so you don't have to go a million places and fight through a bunch of PWs to get there. Okay, so currently, right now, year over year, 6.9% home price increase, according to CoreLogic on U.S. home prices. Month over month, negative 0.4%. Okay, they're forecasting now, year over year, as we get to December 2023, that will actually have a 3% increase. So CoreLogic, more of an optimistic look what's happening for home prices. Okay. Year over year glance on a percentage change for home prices. Obviously, the West has been impacted the most, and that's a less than 5% overall decline. You got some pockets here of less than 5% declines, and then you've got increases basically everywhere Southeast. When you look year over year, still considerably strong. Some pockets here in the Northeast as well, considerably strong on price increases. Here you can see a little bit more these year over year numbers. We know right now, if we're looking in the last 3-4 months, that some of these are going to be down, right? But this is just year over year. Miami, which across the board, I haven't found anybody that believes Miami is going to drop this year outside of like a couple doom and gloomers on YouTube. But even Goldman Sachs, who's got most of these cities going down here in 2023, still has Miami going up. Let me know in the comments if you are a Miami real estate consultant or agent and agree with that. Here are the top metros according to CoreLogic that are in risk of price decline. So it's interesting because we've seen Goldman Sachs talk a lot, about Austin, Texas, and some of those western cities, including Phoenix and as well as even San Diego. But the top markets at risk for home price decline, according to CoreLogic, are none of those. They've got Salem, Oregon. They've got Bellingham, Washington, another Washington location here, Bremerton. Okay, I wanted to make sure I got that right. If you notice there, I was really struggling with Bremerton, Silverdale. If you're from that area, go ahead and roast me in the comments if you want. And then you've got Fort Walton Beach, Destin, Florida. That's the Panhandle area, very high, above 70% probability of a price decline. You can see the confidence score here in these price declines, 70% probability or more of a price decline. And then Olympia, Tumwater in Washington. So 3 state of Washington locations, another northwestern location, and then 1 location in Florida. Interesting viewpoints there from CoreLogic, because it's not in line with what we've seen from Goldman Sachs and others who have really been, kind of targeting some of those big growth cities like Austin, Phoenix, Houston, Las Vegas, and others. That is going to be available along with all the slides down below. If you want to read through that, just hit our daily download below. If you've been using the daily download, hit the thumbs up for us. By the way, anytime you share this video, it helps it reach more people. If you could consider sharing this with somebody who wants a 24-hour look back on the housing market, please consider doing that. And on nowbam.com, you can just go to our website, or you can get it down below. We also have Fannie Mae's Consumer Perceptions of the Housing Market that just came out this week. Okay, so let's take a look at the differences between January 2023 and the month prior. Housing unaffordability still weighing heavy on the consumers' minds. Elevated mortgage rates, obviously, home prices have remained high, and thanks to low inventory. Now, I don't know. I would say not thanks to low inventory, basically. But okay, that's what we're saying here. Thanks to low inventory, only 17% of consumers think now is a good time to buy a home, right? Because if we got an increase in inventory, right? Let me know in the comments who needs an increase in inventory right now. We would see this affordability come down. So that makes sense. That's just one of the latest findings here on the HPSI. Okay, we've got 3 charts down below to look at the HPSI, and this is Fannie Mae's, right? So home price sentiment index, you can see here, while we're starting to come up, consumers start to feel better right now, the last couple months, than they have in recent memory. We're still well below any of the last really 10 years. Let me go to this view just to show you here what I'm talking about. Here we go. This is 2011 right here. Okay. And so 2011, 2012, most markets, this was the bottom of the market. Okay. We're on the rise here on confidence, but we dropped below those levels, and now we've just gotten just kind of flat with where we were in 2011 and 2012. So this is how consumers feel about home purchases, right? This isn't how agents feel. This isn't how the economists feel. These are how the consumers in your market feel. Obviously, this was when nobody knew what the heck was going on in the world. You take that out. 2011, 2012 was the end of a really long and hard, housing recession. And that's where their feelings are back to that level. Okay. So obviously, coming into 2012, confidence started to go up and it continued to rise, for the next 8 years before this little blip. And then confidence, certainly came back coming out of the initial COVID years. But we are now back at a really low mark, despite the fact that we are seeing this slight increase, and hopefully throughout the year we'll continue to see an increase there. Okay, that's again according to Fannie Mae's survey. Respondents who say it is a good time to buy. Okay, good time or bad time. Okay, so this blue line here would be good time. We're at the lowest level since since we hit a low level in September, October. We ticked back up and then kind of ticked back down. So we've been floating in this 16 to 21% range. When we look at January 2020, before COVID, we were at 60% of respondents saying, hey, yeah, now's a good time to buy. 2020 felt like it was going to be a pretty normal market until we got, into March, and then things completely just shifted around. Okay, bad time. We're now at 82%. So net good time to buy. You can see here right now in January 2023, we're at the lowest disparity between the two at 64%. That's even lower than that September, October timeframe from last year. These are important data points to look at because these are the feelings that consumers are having in the market. And the best way for us to gain trust and build rapport is to address those fears up front, to address those feelings, especially if you're an agent or somebody consulting home buyers, home shoppers, and investors. Respondents who say they would buy or rent if they were going to move. I like this because, listen, 71%, more than at any time since 2020, say they would actually buy if they were going to move. So we're down to 28% say that if they were going to move right now, they would rent. That's been pretty flat since 2020. We were at 32% in January 2020 to 28% now. Got down to 25% at one point there on the rent, but we're here at a high mark for buying. So people are like, okay, you know what? If I were to move, I'd still want to be a home owner. I think that's really important, at least for the future, the next maybe 12, 18, 24 months, as we hope to see confidence start to go up. All of that's going to be available for you down below. Again, we'll continue to watch jobs on this show very closely. It's going to be really important for us to see what Jerome Powell does in March, because that's going to have a direct impact on our 10-year and our 30-year fix, which we've seen in the last week continue to go up. But where are we here today? Today, luckily, the 10-year has hopefully seen its top, spread here for the moment. We are at a little bit of a tick down. We're at 3.591 on the 10-year. Yesterday, the 30-year hopefully hit its top mark from the day before at 6.45. We did see it tick down to 6.42, well off of our mark from last Friday at 5.99. We'd love to see that number come down. Hopefully it will today. We can get under 6.4 without a bigger increase from the 10-year. I don't see it getting close to a 5 handle anytime soon. Today here on BAM, we have the walkthrough, 5 p.m. Eastern. That will be premiering. Candace Decker and a surprise guest. Okay. But first time for Candace, I know, on the walkthrough. Make sure you tune into that. If you missed the cold call event last night, I know over 2,000 people have viewed that event. We made live cold calls from 4 to 6. If you're an agent, you definitely want to go check that out. That's in our live tab here on the channel. And I think that if anybody has heard from Dan, because he walked off the set last night, we are worried for Dan's health. He was losing badly to Tom Toole. He walked off. I don't know what happened there. I want to thank Tomo for letting us use their space here today. I think we'll be back here tomorrow as we close out the week. So make sure you tune in. Please consider sharing this video with somebody who wants to know everything about housing in a 24-hour window. We'll be back here to finish the week tomorrow, Friday, 9:30 Eastern. Until then, toodaloo.